Tesla just set a new record for cars delivered, beating analysts' estimation by a lot. Today, I'll look at why Tesla crushed the expectations, and more importantly, I'll show the one metric that will decide if Tesla stock will rally or if it will crumble when Tesla reports earnings in just a couple of days. So, there were three main reasons why I believe Tesla blew past expectations. Firstly, the auto market is much more resilient than the analysts were expecting. Since Tesla sells around 50% of the cars in the US, where it owns 62% of the market, the most important factor is how strong the US market will be. Cox Automotives, a huge auto research company, just raised its forecast for 2023 significantly, as it now estimates around 15 million new vehicle sales in the US compared to only 14.1 million that it previously estimated. But even considering the higher forecast, Cox Automotive still has the lowest estimate for the US market, as other industry experts expect up to 15.9 million cars sold in the US in 2023. But how can this be possible? Just last month I showed you how consumer affordability was at a record low, since on average a consumer needs 43 weeks of income to purchase a new vehicle compared to 35 weeks before the pandemic. And the answer lies in the supply chain. After years of constrained auto supply, more cars are produced in 2023, which is driving the US sales growth. Moreover, the most important factor for EV sales is the pricing economics, which are quite abnormal for two reasons. On one hand, the average price for a new car is still close to an all-time high. Vehicles that cost more than $60,000 represent more than 25% of the market, growing from just 8% in 2017. Lastly, Tesla completely dominates the luxury market with more than 25% market share, but at the same time, the opposite can be seen in the EVs market. The average price for a new EV dropped a staggering 15% from the beginning of the year, much faster than the 2% drop that the average new car recorded. And this trend has been all started by Tesla, when the company decided to apply aggressive price cuts to gain market share.
We've taken a view that pushing for higher volumes and a larger fleet is the right choice here versus a lower volume and higher margin.
And that's the second reason why Tesla surpassed estimates. You see, because of its scale, Tesla has a unique advantage that none of the other EVs manufacturers has, which is the solid margins. Tesla's operating margin, even after dropping in the first quarter, is still the best amongst the EVs, since many automakers haven't reached profitability for the EVs. As a result, Tesla started a price war in many markets, as for instance in China. Since March, over 30 auto brands were forced to apply discounts to keep up with Tesla. Is this a good thing for Tesla? I believe it is for two reasons. Firstly, the EVs are now the cheapest they have ever been, with only a 23% premium compared to the average US car. More people consider buying an EV as their next vehicle, as 51% of potential buyers consider an EV or hybrid. As a result, the EV's adoption continues to grow in the US, where it hit 6.5%. Moreover, Tesla continues to absolutely dominate the US EVs market, with more than 60% market share in the first half of 2023. Lastly, the third reason for better than expected results is that Tesla improved its delivering schedule. The company moves to a more regionally mix of deliveries, and more importantly, it managed to have a more even delivering schedule. For instance, June only represented 54% of deliveries in 2023 compared to 88% just 1 year ago. So, what should we look for when Tesla reports earnings? It is clear that Tesla achieved its goal of gaining market share, but what matters now is at what cost. And there's only one metric that matters in the next earnings report, and that's the automotive gross margin. Tesla applied further price cuts in the second quarter. For instance, in the US, Tesla cut its prices 6.2% in April and 2.6% in June. So, the price for a new Tesla dropped more than 800 basis points since the first quarter, when the automotive gross margin dropped to 18.3%. If we somehow found a bottom for the automotive gross margin, and it comes around 17 to 18%, I believe that's a phenomenal sign that Tesla managed to pass some cost reductions onto its cost of production. However, if the gross margin crumbles, this is the biggest risk that I see, and the stock will probably follow. To sum up, EVs are now more affordable, as the price gap between EVs and ICE cars is now closing. So, it's obvious that the trend of transitioning towards EVs is secular, and it's just too strong, so it's not wise to fight it. Tesla is a crazy growth story. The EVs transition remains strong in spite of difficult macroeconomic factors, and Tesla can absolutely dominate the markets because of its incredible margins and flexibility in execution. That was it from me. If you want to see more financial analysis for Tesla stock, please hit that like button and subscribe.